Anyone young, if we're starting off, you just turned 18, let's say, open your first credit card. You're probably going to get something like a Discover or something, that's a little easier to qualify for. I would literally put it in a safe and put a $10 Spotify bill on it and forget about it. So there's actually two types of refinances. The most common one for sure is the cash out refinance. That's when you have a current mortgage and you have enough equity in your home where you can actually take more than the regular mortgage and replace the first one with a new one, which is bigger. Now that extra gap in between the first mortgage and the new mortgage is going to be cash in your pocket.
What's a rate in term?
So rate in term is where you just take the existing mortgage, replace it with a new one, and you can roll in like closing costs, but other than that, there's no cash going into your pocket.
So what's DSCR? Let's break down DSCR.
So DSCR stands for debt service coverage ratio. It's super, super popular. Probably my most used loan, I would say. The way it works is like this. You don't need to show any income, no tax returns, no pay stubs. All we're looking at is your credit and the rent from the property. If you have a property where the rental income is $1,000 or more, you can qualify for that loan based on just that.
How can someone buy a house with such high interest rates at 7% currently? I guess more or less 6-7. Is it better to wait for the market to cool down, or will prices keep going up?
The rates do have a big effect on your monthly payment, but at the same time, when rates do come down, you will have a lot more buyers in the market. And when you have more buyers in the market, typically prices will also go up because now the sellers have more people competing for the same property.
Hey guys, today on the podcast I had on Joseph Blyer. He is a loan officer and we talk about everything, how you can start house hacking, how you can buy real estate, how you can buy your first home, talk about credit, how credit works, alternative financing. We talk about DSCR loans. I think you guys are going to love this podcast. So like and subscribe and stay tuned. Alrighty, welcome to the YM show. Joseph Blyer, how are you?
Good to see you. It's been a minute.
Good to see you too, yeah. So I wanted to make this episode for all the young investors out there who don't necessarily know how loans work and don't know how they can leverage loans to build equity in a home or, get a real estate property, even like a 1 unit, a 2 unit, a 3 unit, or even a 4-plex, and kind of use house hacking. I want to get into house hacking. I want to talk about DSCR loans, how people, even people with small incomes who are making $50,000 a year can still go ahead and qualify for, let's say a duplex or a 4-plex, right? Mm-hmm. So I want to talk on all these concepts with you today to help other people learn and also learn myself, because I'm more in real estate involved in the managing and in the real estate and the CapEx portion of it. So I think it can really educate and help a lot of other people out there to get their foot in the door. So I wanted to start about like your story first, how you got involved, being a loan officer. I think you work at FM Loans, right?
Yeah, FM Home Loans.
Nice. So how did you, what intrigued you and how did you get involved in that industry?
That's a great question, one I get pretty often. So I started off in ABA, and then over time it got like a little bit mentally draining, and I was like, I need to look for something else that I think could fit, for the long term. So that's when I switched over to sales. I was looking at a few different sales jobs. So I started off in ABA therapy, and over time I was looking to transitioning to a different field. I was always fascinated with real estate. I thought it was really cool, and I wanted to be in the sales world. So I was looking at maybe being like a realtor or something on that end. But over time I realized a lot of people around me were all realtors, and a really good fellow I knew was actually on the mortgage side. So I wanted to ask him some questions, kind of like what we're doing right now. So he invited me for breakfast. We went over a couple, different scenarios of what a day in the life looks like, things of that sort. And I was really, really intrigued. So I went for it, took my test, and now we're here.
And what does the process look like for, let's say someone's out there, they want to become a loan officer, they want to get involved in real estate. How long is that process? And like, I'm assuming it's like one of those tests you have to study for a few months, and then you pass it, and then you officially get your license. That's what I'm assuming, but I'm curious like how that works.
So it's a 20-hour course, which is called the pre-licensing, which is like before you actually get licensed, you have to take a course that talks about a lot of the different things financially, like the Dodd-Frank Act, all these different kind of regulations. Not really as much to do with your actual day-to-day as a mortgage loan officer, more of things that have kind of gone wrong in the past and how we can avoid them, and to make sure like we're not, dealing with anyone doing like money laundering or anything of that sort. So that's a 20-hour course, a lot of information. I highly recommend taking notes and being very, very on top of that. And then once you're done that, there's like a small course that you take at the end, like a test. Once you're finished that, then you can apply to take the test. You would, upload your photo ID, all your basic, kind of like background check information. And then once that's accepted, you're able to actually go and take the test. The test is not an easy one. You need a 75 or more to pass. There's a lot of different type of questions that are kind of meant to trick you. So you have to really, really know your stuff. But I would say it definitely pays off once you're licensed.
And then how does that work? Does it work per state? Like if you get your license, is it like you're only good in New York or only good in Florida? Like where are you licensed currently now?
Great question. I'm licensed in 6 states. I'm in New York, Florida, New Jersey, Georgia, Colorado, and North Carolina. Every state is a little bit different. So let's say Georgia to Florida is a very, very easy transition because those 2 states have a lot of similar rules. So I didn't even have to take any more hours or anything from them. It was pretty much just paying and submitting my fingerprints again, and then took them some time to approve. And then my temporary authorization came in, which means you can do loans now until you're like fully approved. And then once you're fully approved, then you're just good to go.
And so it's like you basically get reciprocity by just doing that. Okay,
Exactly. But
cool.
some states, like let's say New York, you have to take like another kind of like pre-licensing, which could be another like 5 or 6 hours. And every state is more difficult on certain things. So I would say New York is probably one of the harder ones.
Okay, noted. So how can people who are young, I mean, even older people, but like I'm assuming most people listening are younger, how can they basically use debt or use a loan as a tool to build wealth? Because, there's a lot of people in the Dave Ramsey camp. I'm pro a lot of what Dave Ramsey says, but I think there are ways to use debt safely if you're responsible and you're good with your credit cards and you understand the risks. But I want to get into, to change people's mindset and educate people how they could use, loans as a tool and debt as a tool to build wealth.
I think the word debt in general does sound very scary, like something we were always taught as kids, like never go in debt on anything. I think there's kind of like 2 types of debts. You have like your credit card debt, car finance debt, and things of that sort, where it's more of like a liability. And then you have things that are more of an asset, which is, like a mortgage, for example. That's an asset. You're buying a property that over time, I mean, if you look at the last 100 years, consistently goes up in value. I mean, there's obviously good years and bad years. You can have a 2008, and then you can also have, like a COVID when things go up exponentially. So yeah, the market's going to have both sides for sure. But year over year, if you buy a property over time, if you zoom out in the big picture, you will be profitable over time. So my parents bought a house in around 2012, and they bought it for $200,000. It was very, very tight, but we made ends meet. And over time, if you look back, you look now, it, thank God, appreciated significantly. It's north of 900,000 right now. So now they have a lot of money in equity. If they decide they want to sell or cash out refinance, they can literally put money in their pocket just because they bought a property, a while back.
So if you can break down, like to dumb down a cash out refinance, so people hear that word, and if they're not necessarily in the real estate world, I mean, a lot of people, most adults know, but younger people who are, let's say 18, 19, 20, they don't necessarily know what a cash out refinance is and how that works. So I wonder if you can break that down.
Sure. So there's actually 2 types of refinances. The most common one for sure is the cash out refinance. That's when you have a current mortgage and you have enough equity in your home where you can actually take more than the regular mortgage and replace the first one with a new one, which is bigger. Now that extra gap in between the first mortgage and the new mortgage is going to be cash in your pocket. So for example, I have a borrower right now with a property worth, let's say, around 1.3 million. He currently has a loan of 750,000, right? Now there's enough equity in the home where he can take up to 930, so another like $200,000 that he can literally cash out in his pocket and now use to buy another property or for other business purposes. So that's a cash out refinance. We're taking the first loan, we're getting rid of it, we're paying it off, and we're giving a new loan of, instead of 750, of let's say 950 or 930,000.
So it just basically continues on that payment for that person.
It's a completely new loan, actually. It's like starting from the beginning.
So what would be the negatives? Let's say someone's like, oh, I don't want to do that because I want to pay off my house. I don't want to go and now have more debt to pay off.
So that's a good question. I would say we would always run the numbers first. I mean, closing costs is something that comes into it. If you have a bigger property, sometimes that could be 20 or 30,000. And if you're only going to end up, after paying off the first loan, maybe only keeping 50 and 20 or 30, that's eating into your closing costs, you might not be cashing out enough where it makes sense to do it. So it's really a numbers game. Like I've told people, I think you should do a rate and term refinance, which is the second one we're going to talk about in a second, instead of a cash out, because you're not really cashing out so much money. And, you have closing costs and other factors in it as well. And you're starting your payment all over from the beginning.
So what's a rate in term?
So rate and term is where you just take the existing mortgage, replace it with a new one, and you can roll in like closing costs. But other than that, there's no cash going into your pocket.
So basically, let's say when you got your original loan, the rates are super high like they are now, and then rates come back down. You can basically refinance like that, where you switch back to the lower rates.
Exactly, that's exactly what it is. You're taking
of
your existing loan and replacing it with a loan with a lower mortgage rate. So a good example that I deal with all the time is like a fix and flip type of loan, where someone took a hard money loan, which is, let's say, anywhere from 9.5 to, let's say, 10.5%, and they want to get out of that loan now, but they don't really need to cash out of the property because maybe it didn't appreciate that much from when they bought it, or maybe they don't want a bigger loan. They want the payments to be lower. So if you do rate and term refinance, you're replacing the current loan with a brand new loan with a lower interest rate, and usually your interest rates are actually going to be lower on a rate and term than on a cash out refinance because there's less risk for the bank. So
Okay, interesting.
it's like a safer loan in a way.
So I guess I before I did this, before we filmed this, I put on my WhatsApp, or it was Instagram, I forgot what it was. Whoever's like interested in specific questions to ask you. So my buddy Mo's asked, he's like, how can someone buy a house which is with such high interest rates at 7% currently? I guess more or less 6-7. He said, is it better to wait for the market to cool down, or will prices keep going up, or is it smart just to buy now and refinance later?
So that's a really, really good question. The rates do have a big effect on your monthly payment. But at the same time, when rates do come down, you will have a lot more buyers in the market. And when you have more buyers in the market, typically prices will also go up because now the sellers have more people competing for the same property. So it's really about your monthly payment where you're comfortable with. If, let's say, the monthly payment at $3,500 is too expensive, maybe you should wait for rates to come down and your payment goes down to like $3,200. But if you're comfortable at $3,500 and the rate is a little bit high, not ideally where you would want it, it could still make more sense because you're not competing with 25 other people on the same home. You have, a lot more leverage with the seller. You can ask for a seller's concession and other things of that sort, which can definitely get you a better deal. And later down the line, if rates come down, you just, you do a rate and term refinance. If rates go up, at least you're locked in that lower rate and you weren't just wasting a time, like a whole year waiting for rates to come down and nothing changed.
And then another thing I wanted to get into is house hacking. How could someone buy a duplex today? Let's say they're not making a lot of money. And I want to touch on DSCR loans too, but how could someone buy a duplex? Everyone says there's house hacking, right? So I guess the basic idea is, someone goes and ties up a duplex and then they have their tenant on the bottom floor, I guess, pay their mortgage off or at least help with that payment. So how does someone qualify? Someone's young. How are they want to go buy, let's say, a duplex or a fourplex. How do they go ahead and qualify, and how does that process work?
Great question. So I would say the best way to start is like this. You want to know your deal inside out, even better than your lender and your mortgage broker knows that deal, because this is your baby, right? If this is your first property. So you want to know what is your rent on this property. That's the most important. Taxes and insurance. Because once you know that full payment, you can actually underwrite the deal and see if it makes sense or not. So once you have those 3 or 4 factors in, then the way it works is you can actually use up to 75% of the income from the other unit. So let's say we're using a 2-unit example, right? You live in unit A, tenant lives in unit B. You can use up to 75% of unit B's rental income to help you qualify for the full monthly payment of both together. So that's how you can basically leverage your income in addition to the tenant's income to help you qualify for that loan that you wouldn't have gotten on your own.
So this is how you have young guys who are 19, 20, 21 buying, duplexes and fourplexes when they're only making, X amount a year where they're not making a lot of money.
Exactly. And another thing to touch on, when you're actually living in the home, you're going to get a lower interest rate than a regular investment property because it's considered a safer loan. So you're actually going to save money on that. And then also because it's your primary residence, you can also put a lower down payment. You don't have to put 20%. You can go as low as like 5 or 10%. So if you don't have the most, equity, it is something that can definitely be very profitable over time. The couple downsides I would say that you should look into is you do want to have enough money saved up in case, God forbid, you have a vacancy or air conditioning breaks or any of these type of things that do happen. You don't want to be down to your last, 5 pennies after the loan, because if this guy leaves or something, you're going to be liable for that full payment. So it's something to keep in mind when you're, investing in it.
Okay. So no, I want someone to be watching this that's 20 years old and they're going to go and they're thinking about renting their next apartment. Their rent might be $2,500, $3,000, whatever it might be. And I want them to go ahead and buy, to house hack, to buy that duplex or buy that fourplex. So I guess what's the, like, let's say, like, I'll give you an example. Let's say you have $1 million duplex, right? There's 2 units, $500K a door. It's in a nicer area, and this person's going to go and he wants to qualify, right? Since he's living in one of the units, he only has to put 5% down.
Correct.
So he just puts 5% down, and let's say he's making $50,000 a month. The DSCR loan could cover that because of his
DSCR
tenant.
is another side. I would say, house hacking you're usually going to do with a FHA loan or a conventional loan, because you would actually move into the property yourself and then rent out the other unit. And when you're living in it yourself, it's considered your primary residence. It's okay having a primary residence and having 2 or 3 units attached to that primary residence. That's fine. It's still where you live. That's where the house hacking comes in, because you're putting a lower down payment and you're also getting lower rates. And the idea of it is that this tenant is going to pay either all, or in a great situation, be all, or at least a lot of your mortgage payment. And that way your rent from that borrower is really covering part of your mortgage and part of the other unit.
So what's DSCR? Let's break down DSCR.
So DSCR stands for debt service coverage ratio. It's super, super popular. Probably my most used loan, I would say. The way it works is like this. You don't need to show any income at all. No tax returns, no pay stubs, none of that. All we're looking at is your credit and the rent from the property. Now, what does that mean? A practical example is, let's say your mortgage payment with taxes and insurance, everything all in, is $1,000. If you have a property where the rental income is $1,000 or more, you can qualify for that loan based on just that. Your credit is looked at a little bit heavier than other loans because they're not looking at your income. So if you have like a 650 credit, it's going to really, really affect the rate. But if you're at 700 plus, you'll have a pretty solid rate and not have to show any income at all.
Very cool. So I'm saying, like, a lot of people who are young, let's say like they're 18 and they have 10 grand in their bank, they can literally put 10 grand down. Let's go to Jacksonville, buy like an $80,000 house, $100,000 house, maybe with closing costs be 15 grand. They can put that down. Let's say their mortgage with taxes and everything was going to be like $850. They can rent it out for $1,000. They can cash flow $150.
Yeah.
Get some appreciation out of it and use that DSCR loan because they're not working. They're in college.
Exactly. They don't have income to show. It's a perfect scenario. Another cool thing about it is you can close in an entity like an LLC instead of your personal name. So my investors love that, because if someone, goes after them on a lawsuit or something and they're protected by their entity, it's technically not their property, it's the entity's property. So that's another cool part about it.
So let's say someone's shopping around for a loan officer. How do they know they're getting the best rates? And how do they know like they can't be getting better rates elsewhere? Like, how do people typically shop loans?
So I would say the best way is you want whoever is pricing you out to know your exact situation. What a lot of people will do is they'll say, oh, this lender or this broker or whoever it is, quoted me X rate. And then I'll be like, did they do like a soft pull and see where your credit is? Or did you tell them, around where your credit is? They're like, oh no, they just gave me a quote. So how do you know they didn't price you with 800 credit when you might have 710? That could have a big, difference in rate. Did you tell them what type of down payment you want to make? 20 or 30% can also make a big difference. Every threshold will have an effect on the rate as well. So there are a lot of different things you want to keep in mind. The basics, I would say, the most important is asking, am I being charged points? That's the most important question I would ask if I was going right now to shop. If I couldn't use myself and I was, putting 2 or 3 different lenders, I would say I want a loan at 75 loan to value, or I would just tell them, I want $1 million property. I want to put down, let's say, 250,000. My credit is around, 740 to 750, let's say, and I make X amount of money. Can you, price me out? What would that look like? And then they'll, tell you what that would look like. What a lot of people will do is they'll quote you, let's say 6 or 5.99 flat, and another lender might quote you 6.5, and you're like, oh, obviously gonna go with the 5.99, right? Because it sounds better. But a lot of times what people won't tell you is they're charging you 2 points, 2% to do that. So they're basically not mentioning anything, and you're assuming everything is all good and dandy because you have a lower rate, and then it comes to closing costs, and now you're paying an extra 10, 15,000 that you didn't know you were paying, and you're like, whoa, what's this about? And they're like, oh, it was to buy down the rate, and you're like, oh, I never agreed to that. Like, I didn't know. So you want someone that's honest with you, that's straight up. You know, when they give you quotes, they should give you multiple different options, one without points, one with points. You know, does it make sense to pay points? In many cases, it doesn't. If you're only keeping a property for a year or two, you know, paying a full point, 1% to bring the rate down, a lot of times, you know, it takes 24 or 36 months just for that savings every month to make sense. So it's very, very case by case. And you want a lender that's, you know, very honest with you and keeping things, you know, the way it should be. You shouldn't feel like you're very uncertain.
And what type of loans do you mainly do? You focus mainly on single family and like smaller like duplexes and fourplexes?
So I typically do 1 to 4s. I definitely have some commercial deals that come here and there. But yeah, I'm definitely stronger on the residential side, I would say.
Okay, very cool. And what's like a cool story of like someone you've helped that didn't think they can get a loan and they ended up like, you know, thanking you, and it was like a good story?
That's a cool one. So I called a realtor a while back, just catching up with him. You know, every once in a while, I'll call the people that I've worked with before or people I'm trying to work with, you know, touch base, see what's happening, see if there's anywhere I can help. And I asked him, hey, how's everything going? He's like, things have been better. And I was like, what happened? I thought maybe his dog died or something, but he was like, I had a deal and it's basically dead. I was like, what happened? He's like, I'm working with, we'll leave them nameless, but a very, very big lender everyone's heard of, the same as saying like Chase or Wells Fargo. And he had this borrower that he was working with. They were under contract. They were already in the middle of the purchase. They had the appraisal. They had everything. And they told him he had to put 20% down. And I was like, okay, that's interesting. Like, do you know how much the guy makes? He's like, no, I'm not sure, but maybe you could reach out and see. So I contacted this guy. I asked him a bunch of questions to kind of, you know, build a picture in my head. And I'm like running the numbers, and I'm like, he easily qualifies with a lot less than 20. We actually did it with 5%. He qualified with 5%, and they told him, if you didn't put 20, we can't do this deal. Like, we're issuing you a denial letter. And luckily, I happened to be at the right place at the right time. I contacted him, and he didn't lose his deposit, and he actually got the house, and he was super, super thankful, and actually referred me to like 1 or 2 of his friends as well. So that's like a cool story where, you know, sometimes you have to think out of the box. And, you know, sometimes when you're working with a very big bank, they're very, very like vanilla cookie cutter. Like, they only want, you know, 750 credit, you know, 20 to 30% down and things like that, when a lot of times the deal still works with a lot less.
Mm-hmm. And then when you say, like you said earlier, soft pull on your credit, right? That wouldn't affect your credit, right? Because whenever
Correct.
they pull your credit, if you can explain it to everyone, like how that works and
Sure.
affecting your credit.
Credit's a great discussion. We could be on this for like 2 hours. But the basics is like this. When you're applying for a loan, right, and you're trying to get pre-approved, some lenders will do a hard pull when really you don't really need to. You can do a soft pull. If you're just trying to see where the credit score is, typically a soft pull to hard pull is very, very similar range, maybe within 10, 15 points. It's enough to get a ballpark where you can actually price it out. What some lenders might do is they might do a hard pull, and then a lot of people have a misconception that once one lender does a hard pull, they can't work with anyone else. That is completely false. You can completely work with other people. And actually, if you run credit within 30 days and you go to another lender and run credit again, it's not meant to affect your score because you're allowed to shop. It's kind of like part of the mortgage process.
Mm-hmm. So if someone goes to one lender, they do a hard pull, they're looking into a certain property, and they go to another, or even 2 or 3 other lenders just to really shop around. It's not gonna bring their
score lower.
Their score lower.
It might in the short term, but long term, it really shouldn't. It's part of, even in the short term, it's not really meant to. You can always contact the bureaus and say, look, I'm shopping for a mortgage, but I've dealt with multiple clients that I've seen 3, inquiries in a row, and their score was the same.
Mm-hmm. Interesting. So why would it affect, like, I don't know anything about credit, so I'm curious. Like, why would it affect your credit? Like,
a hard pull?
People are always curious. Like, what
so
does it actually
every
do?
inquiry, which means when any company, even not mortgage related, like if I apply for a new, let's say Amex card, like the new Amex Gold or Amex Silver, when I apply to them, they run a hard pull. It will affect my credit in the short term. It'll go down a little bit, and then in the long term, it'll go back up. But if you have many inquiries, like let's say I applied for a car loan and then 3 credit cards, and so if it's one after another, a lot, that will have an effect.
Interesting.
Yeah. Back to the soft pull you asked. Soft pull will not have an effect. It's almost like on your banking app when you go to your like credit journey on Chase, let's say, and it shows you around where you're at. It's a similar idea. For mortgages, actually, a soft pull will typically look different than your credit score will look on your banking app. It's not always one-to-one.
So let's say, okay, so someone was asking me, he's like 18, and he's working, he's probably making, he's also full-time in school, he's making like $35,000 a year.
Right.
And he wants to tie up a property. You know, he's been watching YouTube, he's been getting involved in real estate, and he's like, hey, like, how can I go about getting a duplex and doing house hacking? Because I think he's paying rent, like, I don't know, it's with another friend, it's probably like $1,500 a month. So how could someone like that with a smaller income and such a young age and probably not the best credit go ahead and like buy and tie up a duplex? Would that be a DSCR would be the best option?
I would say you could still do it with an FHA loan. It's definitely possible. You can also do DSCR. A few things. First off, if this person is really confident that he's going to be able to make the payments and it's not an issue, you can also get something called a cosigner, which is basically someone else that's going on the loan with you. They don't have to occupy the residence, like the actual property. But if they, like, for example, let's say someone makes $100,000 a year, and to get this property, let's say they need to show $200,000 of income. Let's say their wife, for whatever reason, either works off the books or doesn't work at all, and they can't use her income. They can use a friend, a father, uncle, I mean, anyone pretty much that's willing to co-sign on the deal and use their income. Now, the same way we look at their income situation, we also look at their full debt situation as well. So if this person has, you know, if they're driving around a really nice BMW and a lot of other things and they don't show the most income, that's also going to be factored into it. So you want to make sure if you're using a co-signer that, you know, the numbers work, which is what we'll do.
Interesting. No, so I guess back to like renting versus buying. A lot of people currently, I mean, for everyone listening, what is it, like September 10th or something in 2025? So a lot of people are saying, I mean, it's like interest rates are insane right now. They're high, taxes are high. You know, in Florida you have the HOA, so like it's like, you know, you're all in. It's going to be probably 30% more to buy. So a lot of people are like, hey, I think it makes more sense to go ahead and rent because I can keep my costs 20, 30% lower, and I can use that money to invest in education, invest in learning, invest in real estate, or invest in, you know, I guess the stock market, invest in other things versus, you know, deploying a lot of capital, $100,000, $200,000 for your down payment towards your apartment, your home, and then having, you know, to pay, you know, your interest and taxes and HOA and insurance versus when you rent, it could be a lot cheaper. But also, I guess that way you're not building equity.
Right.
So I'm curious what you think about that, if it's situation dependent or you're kind of like everyone should buy.
No, I mean, the easy answer is everyone should buy. No, I'm kidding. I would say it's very case by case. You know, if you're much more comfortable having your money, let's say liquid, a lot of times stocks makes a lot more sense. You can put in the S&P and get between, say, 7 to 10% annually. And if you ever decide to sell, you can just sell and, you know, buy something else or whatever it is. So it is very case by case. I would say if you have the money, you know, you found an area you really like that you think can appreciate over time. You want to build roots there. You want to build a family. That's a perfect situation where, you know, even though there are certain things in place that make it, you know, the short-term cost is definitely higher. There's no arguing that. But the long-term cost is, you know, you're locked in with your taxes. Hopefully DeSantis gets rid of that entirely. That's another.
Yeah. What do you think about that? Is that like actually?
I think that would make me millions of dollars.
But
it would be very nice.
But is that realistic? Like, what are people saying who actually are involved in
it? Looks like it's possible, but we'll see if it gets passed. I mean, he's definitely pushing for it. I think it would make the housing market here insane. Everyone would want to move here, especially with the new governor. I mean, the new mayor in New York also, I think, will have you know, a mass migration here. Things will definitely get interesting.
It's definitely going to be better for you if Mom Donnie wins. You're going to be chilling.
I mean, for real estate in New York, it's going to be rough.
Yeah.
Because, I mean, it's rent stabilized. If you're stuck at 3% and you could even grandfather your kids in for later, like, it doesn't even make sense to purchase. It's way the people that own these properties are losing money every month on them, typically. It's a crazy.
Because they're also having inflation on their own, on maintenance costs, on supplies, on ACs.
I'm saying inflation alone is 3%. So if it's only going up 3%, you're not even breaking even. You're, there's always going to be an air conditioner that breaks or the heating or something, vacancies. Yeah, it's a scary market there.
No, but I'm saying back to DeSantis. Like, how is Florida going to be sustainable with, they already don't have an income tax, and now they're going to get rid of the tax on homes. Is it specifically just on residential homes, or is it also on like big commercial properties?
That's a good question. I thought originally it would only be residential. From what I read, it looks like it might be. I don't know about commercial, like 100 units, but I think like 1 to 4 might also be included. From what I saw, I mean, definitely do your research because it hasn't been finalized yet. But from what I saw, it looks like it might also include investment, which would be huge.
Oh wow.
Yeah. Especially if you're looking in an area like
that would make a lot. I mean, because a lot of people are like, hey, like I want to tie up a house, or but let's say I buy $1 million house and it's almost 2% in taxes. It's like it really adds up, or even $2 or $3 million house. It just like doesn't make sense for a lot of people to buy. On top of HOAs and all that other stuff.
Yeah,
and obviously insurance is not cheap at all. Do you also work with like specific insurance people? Like, let's say you have a client, they come to you, they buy their property. Do you know other people like insurance brokers and other people in the industry that you guide them through and you help them with?
Yeah, so I actually have other contacts. I wouldn't call it specifically a team because they're not like only working for me, but there's a couple people that I work with closely, and any deal I can work with them, I always try to, because it's always a pleasurable experience. I can call someone right now at 6:13. It could have been in 2 hours from now at 8:13, and I'm very confident they would answer my call, text, email, like quick like this. And that's something that's really cool in the industry. Like when you're working with people a lot and you close a couple of deals with people, they start working with you a lot closer, and things are going to get done. Like if I tell someone, title's going to happen in 5 days, and my title lady said that, I know it's happening in 5 days. Like I'm very confident on that. Same thing with insurance. Like if I have an insurance guy that I know is good, that he gives good rates and he moves quick, like I'm very confident referring him to even like a close friend or partner that I work with, because, I trust them.
When you first started, right, you're very young and you still are. So how is that, like, how was that for you personally breaking into the industry? Like, I guess for everyone listening, like, when you're starting off, like how hard was it to get your first deal done? Because you're new, like how does it work? Is it commission based? Is it also salary based for someone who's interested in becoming a loan officer?
So it depends on what shop you're at. Some places will give you a much higher commission, but no salary. Some places will give salary, but very, very low commission. And then some are somewhere in between. I'm pretty much in between, but I would say I'm higher on the compensation side, lower on the salary side, which is kind of where you want to be, because you want to be motivated to bring in more deals. And then regarding your first question, you said earlier, my first deal was really, really difficult. On top of being a condo, it was also someone that was like self-employed that paid themselves through their own company. So it was really, really hard deal. And besides qualifying the borrower, the condo itself had a lot of issue. I was actually the third lender to touch the file. Like 3 people gave up on it before me.
And that was your first one.
Yeah, that was my first deal. So like, it just goes to show, like, if you like just keep pushing, you will be able to get it done. It was not easy, but I'm really, really thankful I kept pushing. Like there was at least 2 or 3 times when it looked like it wasn't happening, and I just wouldn't take no for an answer. Just kept pushing.
Okay, very cool. And then to roll back to the first time home buyer, what are, like you say, what would be the 4 qualifications like everyone would need to be like, okay, I'm ready to buy a home now? Like what should their income be compared to their mortgage? When would you actually advise someone not to buy a home? Like, hey, you're not ready to buy a home. Or when would you actually push someone like, hey, I think it's time for you to get a home?
That's a good question. I would say, so the first is called DTI, debt to income. That's a really, really important one. That means your total income is, let's say, $100,000. How much of that are you spending? And then once we add in your full mortgage payment with taxes and insurance, what is that ratio? So I guess to use easy numbers, let's say you make $100,000. Let's use even easier, $10,000 a month, right? If you're making $10,000 a month, and let's say you're spending $4,000 on your mortgage, tax, and insurance, everything all in, and another like another $500 on, let's say, total with car payment, credit, anything else, full liabilities, then you're at a 45 DTI ratio, right? You're making 10, you're spending 4,500. That's around the area you want to be, between, I'd say, low 40s to, let's say like 49 is on a conventional loan is the highest we can go. With FHA, we can go a little bit higher to like 57, but like you don't want to be crazy over leveraged, where you're not comfortable with the monthly payment. Now, at the same time, I also work with a lot of people that might not show everything they really make. They write off a lot of taxes. So maybe we can only use 100,000 to qualify, but they know, that in reality they're making more than that, and they can actually, comfortably pay a bigger payment. Those type of people, I would say, you could take a higher debt to income ratio, and the deal would still work. And I would advise it to still continue. Someone on the other hand that it looks like they're maxing out to like the last penny, and after closing, if closing costs went up 1 or 2 thousand, they start kind of like freaking out that they're not going to be able to close this. Then I usually say like I think you need a little more money, to make this make sense.
Like reserves, because
Yeah,
a lot of things
reserves
come
is
up.
important. A house, it's not the same like when you're renting where you can just call someone when the bathroom breaks and magically a plumber comes to your house. It's all paid for. You don't think about it. When it's your own money, if the plumbing goes bad, the roof, anything like that, those are things that can happen. Ideally, they don't happen often if you have a good inspection. Super, super important. Whenever you're buying a house, make sure you do a proper inspection. Don't waive that. Not something you want to play around with. Going
Okay.
back,
Yeah. So 45% DTI, right? What
yeah.
else?
So that's
And
the
also
debt to
good
income
reserves.
ratio.
I would think you want to have solid reserves for
Yeah.
a roof, maintenance. Like what's a percentage people in general should save aside or have aside for their house, like, or, for maintenance.
I would say between 6 months to 8 months of your total principal, interest, taxes, and insurance payment, or people also say PITIA.
Okay. So what are the other qualifications?
So you have the DTI, then you have assets, which basically just means how much money you have in the bank. Um, that's for down payment and closing costs, and any other loan costs if you're paying points or anything like that. You want to make sure you have all of that, in your bank account ready to go. So that's for assets. Then you have income. That's how much you make that we can use. So how much do you show on your taxes that's usable? That's for income. And then the last one is debt, which is, your credit cards. This is kind of a subject we touched on earlier. I actually want to go a little more in depth if that's cool. Um, with credit cards, it's not so hard to have a good score, but it's very easy to have a bad score. What I mean by that is, I think it's very important to get properly educated on credit. I really wish they taught this to us in school, and I'm very thankful that I'm in this industry because I've actually helped a lot of my friends and other people. I would say anyone young, if we're starting off, you just turned 18, let's say, I would say open your first credit card. You're probably going to get something like a Discover or something, that's a little easier to qualify for. I would literally put it in a safe and put a $10 Spotify bill on it and forget about it. Forget it and put it on auto pay, of course. Auto pay is something everyone, no matter how old you are, even if you always make the payments, you should put on auto pay. If you go on vacation one time for a weekend or something, you weren't paying attention, you don't want to miss payment. It's just not fun. It's not ideal. So if you put auto pay, at least for the minimum, if you have the money to do the full, I definitely recommend that. That will definitely help make sure you have no missed payments. That's one that's very big. The second super important factor in credit is your utilization. What that means is your total credit limit. So for example, I have a Chase Sapphire card. Let's say I have a $10,000 limit. If I'm spending $1,000, that means I have a 10% utilization. If on the other hand, I had another card, let's say that was $1,000 card, and I spent $900 on that card. Let's say that was the only card I had. Now my utilization is 90%, which is really high, even though it's only $900, right? So that will have a negative effect on your credit score as well. If you have high
Even if you pay it
balances.
on time.
So if you pay it on time, then it doesn't matter. As long as you pay within the month, then at the end of the month, your balance is going to be zero. So it's irrelevant. But if you're carrying, a cost, let's say you're making only the minimum payment and you're using a lot of utilization, it will definitely affect your credit score.
Mm-hmm. Let me check something here. This is a question I have. I guess I might as well ask it here.
Yeah, please.
Like credit cards are so confusing, and I've had this conversation with ChatGPT with like trying
It's my
to
best friend.
Yeah, with trying to build. Let's say people want to like get their credit score higher, right? So let me give you an example, right? So look at one of my credit cards here. So
flash the camera.
so it says your payment is due in 3 days, right?
Okay.
Right now it's saying my payment's due in 3 days, September 12th, right? So you have your remaining balance of what I have remaining, and then you have your minimum payment due, right? And then I have my credit limit, right? Those are the three things I'm seeing here, right? So I have my total balance, and your total balance and my remaining standing balance is whatever it is, And then, so let's say I pay this minimum payment that's due, right here it says $50. Let's say I just pay this minimum due payment, right? Then it's not going to affect my credit at all, right?
It won't affect your credit, but you're going to be paying a lot of interest. So the way that works is the minimum payment is basically saying if you pay this minimum payment, you're going to be paying, most cards are between 25 and 30% interest, which is a lot. Talking about interest rates being high.
Yeah. No, it's crazy.
It's crazy. And a lot of people won't realize that. But if you're making the minimum payment, you're basically paying interest on everything else you owe. So let's say you owe $10,000 and you're making the minimum of, let's say, 100. On the rest, you're paying interest every month on that money, and you're only paying 100. So you're basically
but just to clarify for everyone, that's not affecting my credit though.
No, it won't. Right, it won't make your score lower as long as utilization isn't too high. So let's say you're at 20% utilization, right? Let's say you have a big credit limit, and let's say you have, I don't know, 5,000, 10,000 of credit card debt, but you're making the minimum payments. That will not affect your credit score. Your score won't be lower for making the minimum instead of the full.
Yeah, the thing is with my credit cards, I should set up one for charity, for Meiser, because the reason I don't have mine on auto pay, and that's why it says due in 3 days, and obviously I always pay it on time. I think one time I paid like a day late, and I had it was like a $20 fee, and I was like, are you serious? I called them up. I called up Amex, and they actually gave it back to me.
I was about to say that's
a lot of people don't know.
To do. Besides the money, also late payment is not great. You don't want a late payment.
Yeah.
So if you call them and say, hey, I tried making the payment, this is what happened. Is there any way you can help me fix it? A lot of times they'll work with you on that.
Yeah, so it happened to me. I paid a day late, and they literally removed the $20 charge, and it was great. So the reason I don't have it on auto pay is because let's say I'll pay out of whatever I make that month. I always put aside 10 or 20%, whatever I'm feeling. 20% is not easy, but 10% at least, right? I'll put aside for charity, and then I want to pay. Let's say I give to a cause. Then I want to make sure that money, that tzedakah money, right, that charity money is being paid towards that. So that's why I don't have it on auto pay, because then it's set on one bank account. Mm-hmm. So if I do a specific, let's say $500 charge for charity, then I want to go and take it from that account, the charity account. So that's why I don't have it on auto pay, and I have to figure out a way to maybe I should have a separate credit card with a separate bank, and then everything will be on auto pay. I have like a charity auto pay with a credit card for that and a bank for that, and then a bank for my regular stuff.
Yeah, you can do that. Or maybe...
Cause it's just always oh my God, I got to pay in 2 days. I got to pay in 1 day. You know what I mean? It's just
Right. So I always recommend put auto pay, just for the peace of mind. At first I was super OCD about it, and I would go in and make the manual payment every time. Then at a certain point I was like, it just doesn't make sense. I'm stressing about it too much for no reason when I really don't have to. So I put, I recommend putting the most, that way. First off, your credit card shouldn't be used as infinite money that you just have that you can spend. You should use it like a debit card, in my opinion. As long as, look, obviously some people are in very tough financial situations and need to lean on it. That's understandable. That makes sense. But assuming you have the money, you should always make the payment in full. Why would you want to pay 30% interest?
Because it hurts. That's why.
It hurts.
No, people don't want to pay right away. They're I want to wait. You
don't spend as much, when you really see the numbers of how much you're paying, it's unreal. I did numbers with someone, and I showed him the difference. He had $10,000 of credit card debt, and I was like, if you were to pay this off in principal now and basically pay off the entire thing and pay yourself back the same monthly payments, you'd pay off in 1 year instead of 3 years. And then he was like, whoa. We did the numbers, and I showed him how much more he was saving, and it was like, okay, it's a no-brainer.
Yeah, he's going to need some Dave Ramsey.
Definitely.
Definitely some Dave Ramsey.
100%.
Then he won't come to you.
Yeah.
That's the issue. He's going to try to buy his house.
So we'll work together. We'll figure something out.
So I guess another question I had is not non-QM, alternative financing. How does that work? A lot of people don't know about it. If you can dumb it down, break it down for everyone.
Sure. So a lot of people only know about conventional loans, which is a regular Fannie Freddie loan or an FHA loan. There's a lot of different type of financing out there for people that, let's say, are self-employed. They write off their car. They write off this office, let's say. They write off everything, and on paper, maybe they only make 80 or 90,000, when in reality, they're making a lot more. So those type of people sometimes are scared they can't qualify for a mortgage and won't even try. Or what they'll do is they'll show a lot more income and pay way, way, way more in taxes. Sometimes $40,000 or $50,000 more in taxes, when in reality they can use a non-QM product. The most popular ones I would say is there's a P&L program where a CPA can help you with a profit and loss statement. We can use that as one way of income. Another way is a bank statement program. So if you've been in business for long enough time, we can actually look at just your business income. So your bank statements for the last 12 months and see the deposits that are going in and out. And based on that, we can use a percentage of that, usually around 50% to qualify. So for example, like someone that works in Amazon, let's say they have a lot of money coming in for expenses. They spend, let's say, 100,000 on advertising and things like that, and then they make back 150. That 150 that's coming back, we can use 50% of that. So it'll be as if they make 75,000 a month in income, which is a lot of money.
Wow. Okay, very cool.
So yeah, it's a super cool one. So if you're ever worried, my taxes only show 50,000 or 80,000 or whatever the number is, and I want a much bigger house, I'm just going to buy cash. Don't get steered away. Let's have a conversation and see, what other ways we can help you qualify.
Okay, awesome. Good stuff. I mean, I hope people listening learn something from this. And if anyone, found any value in this, subscribe, like, share it with someone. And also, Yosef, where can people reach you? I guess tell them here on whoever's listening on Spotify or Apple. And then on YouTube, Spotify, I think on Apple, I'll put in the description all your information, your
Perfect.
LinkedIn, where people can reach you. So
if you're watching, my phone number, direct cell, you can test it right now and call me. It's 305-206-0947. You can just text me your name and, your situation a little bit. We'll hop on a call, go over all the details, and go from there.
Okay, awesome. Thank you. Yeah, Yosef's a young buck. He's awesome, and he's really good at what he does. He's really passionate about what he does. So shoot him some love, guys, and thank you everyone for listening. And,
Appreciate it.
You got it.